Hello everybody and welcome. Brad Bestgen with Bestgen Wealth Management. Hope you're having a wonderful holiday season. Happy New Year, and hope you're all looking forward to a healthy and prosperous 2021. Now, you may recall in prior video I had discussed the Secure Act and one of the key aspects of it. Today I want to get into a high-level overview of some of the other aspects of that bill as they pertain to individuals and business owners. So with regards to individuals, one of the better points that came out of this was they increased the required minimum distribution age from 70 and a half to 72. Great, another year and a half that you can have tax-deferred growth in your retirement plans. Second, they maintained the qualified charitable distribution starting at age 70 and a half. They did not bump that up to 72, which is great. This means starting at 70 and a half, you can take up to $100,000 a year out of your retirement accounts and donate it directly to charity to avoid taxation on that distribution. Thirdly, they removed the 70 and a half age cap on contributing to an IRA. So if you're still working and meet the other qualification rules regarding IRAs, you can add to it. There's no age limit anymore. There was never an age limit on Roth IRAs. This is for traditional IRAs. And another key aspect is they're now allowing you to take up to $5,000 a year out of your retirement accounts for the birth or adoption of a child to help pay for some of those costs if you don't have liquid funds in another place. So that's great. As it pertains to business owners, there's a few features. One is the more flexibility regarding multiple or pooled employer plans. Now what this means is companies that don't have a plan for themselves can pool resources with other small businesses to get economies of scale, shave down some of the costs, and all those employees and businesses would be under the roof of one 401k plan. Prior to the Secure Act, you didn't really want to do that, or it was hard to do it because you had to be in the same geographical location and the same trade association. Now you don't have to be. And so there's a lot of key aspects of that bill that make it flexible and a little bit better if you were thinking of establishing a multiple employer plan. Another great aspect is the increase of tax credits for establishing a retirement plan in your business. It used to be $500. Now that tax credit can go up to $5,000 a year for the first 3 years after you establish a plan to help defray some of the upfront administrative and initial costs to set up a retirement plan for your business. So this is great if you're a small business thinking about putting a plan in place. That $5,000 credit can really help lower some of the initial costs of getting that plan off the ground. Another aspect is annuities. Annuities were allowed in 401k plans prior to the Secure Act, but a lot of plan sponsors did not. Only, in effect, 10% of plans nationally offer an annuity. Now they've added some safe harbor fiduciary protections for plan sponsors. They want to offer annuities as an investment option in their plan. And so there's still a lot of due diligence you have to do, but it is a little easier and more flexible to offer an annuity as an investment option in your plan. And fourth, there is now the ability for long-term part-time employees to contribute into a plan. They used to have to work at least 1,000 hours a year to be eligible for a 401k plan. But if you work 500 hours for 3 years, at least 3 years in a row, in that fourth year, you can start contributing to the plan. Unfortunately, prior years did not count. This went into effect January 1st of 2021, so that 3-year window starts ticking then, and then in 2024, those part-time employees will be eligible to start deferring into the plan, which is great for part-time workers. Now, a couple miscellaneous items. One, the 529 plan rules were extended to allow you to use 529 plan money to pay off student loans, which is great. Prior, you could not do that. And another aspect is regarding the Kiddie tax law. That tax rate was increased as part of the Tax Cuts and Jobs Act, and it's now been decreased to the rate to what it was prior to the TCJA. So those are a couple positive aspects as it relates to kids and education. That Kiddie tax, especially if you have an UTMA or UGMA account, will apply. So again, this was a high-level overview. We hope you found it helpful. We encourage everybody, anytime there's legislative changes, to talk to your advisors if they're not reaching out to you, to see what aspects apply to you and how it can help your planning. So thanks again for tuning in. Looking forward to next time. Happy New Year and make it a great day.